Need plus moderate bucket. So this is grid 2, that is need plus a moderate risk profile. So in last video, I built the need bucket for a conservative investor, 75-80% debt, very little equity. It was deliberately kept as a very boring bucket. The most common comment I got was some version of this, but I'm not conservative. I'm a moderate investor. Can't I take more equity risk on this money? It's a fair question, and the honest answer is sometimes yes, sometimes absolutely not. And the thing that decides it is not your personality. Today, we are building grid 2, need bucket, moderate investor. And by the end of this video, you will know the exact test that tells you whether you're allowed to sit in this cell at all. Quick context if you're new, we split money by purpose, not by personality. Need is the money for goals that cannot fail. Retirement income, your child's education, the down payment you've already committed to. Want is a lifestyle, a better car, 2 international holiday instead of 1. Aspiration is the dream money, the legacy, the early exits. Cross those 3 buckets with 3 risk temperaments, that is conservative, moderate, aggressive, and you get 9 cells. Each cell gets its own portfolio, not one risk score for your entire net worth. Moderate is a word about you. It describes how much volatility you can watch without doing something stupid. Need is a word about money. It describes a deadline, an amount that are non-negotiable. Think about what actually happens. Your temperament tolerance shows up as a feeling. You can stomach a 30% fall, fine. But your daughter's first year fee is due in April 2029. That date does not care how calm you are. If the market is down 40% in March 2029, your composure does not pay the fee. So your risk profile can never be used to increase risk in the need bucket. It can only be used to reduce it. Read that again if you need to. Being a moderate investor doesn't earn you more equity in this bucket. It only means you may be permitted to hold what the horizon already allows. So what actually sets the allocation is time, specifically years to the goal date. Here's the gate. 4 bands. Under 3 years, 0 equity to 5 years. 10 to 15% equity maximum. This is essentially the grid 1 portfolio from last video. 5 to 8 years, 25 to 35% equity. Now the moderate profile starts to actually mean something. 8 years or more, 35 to 45% equity. And there's a second test on top of horizon. Take your target corpus. Now imagine the equity portion falls by 40% permanently. The year before the goal. Run the arithmetic. Are you still able to fund the goal by dipping into other assets, by borrowing sensibly, by delaying it a year without real damage? If the answer is no, step down 1 band. If the answer is yes, you are genuinely in grid 2. So there are 2 conditions and both must hold. Horizon more than 5 years and you're able to survive 40% equity drawdown. 60% debt, 40% equity. Let's build the 8-year plus version. Call it 60 debt, 40 equity. So here is what a debt category will look like. The job of this category is certainty, not return. So it splits 3 ways. First, the anchor, which is PPF and EPF. If you already have them and the maturity roughly lines up with the goal, these are all sovereign-backed, tax-free, and crucially, they are illiquid, which in a way protects you from dipping into these allocations. Second is the maturity matched core. Target maturity funds or gilt fund whose maturity date sits close to your goal date. This is the single most underused idea in Indian retail investing. If you hold to that maturity, you have substantially reduced your interest rate risk because you're no longer guessing where rates go. You're holding on to the end point. And since the allocation is into gilt, Pretty much you do not have risk of non-payment of the principal. Third is the parking layer for money entering in the final 18 months and for the amount you shift out of equity along the glide. Liquid funds, ultra short term duration funds, arbitrage funds, these are more suitable. So what's not in here are the credit risk funds, corporate FDs from unrated issuers. Anything advertising an extra 2%. In a need bucket, an extra 2% is not a reward. It's a rounding error attached to a tail risk that can destroy the goal. Now we move to the equity sleeve. The entire equity sleeve should be broad market and a kind of boring category, often a large cap index fund or a broad market index fund. That's the core. If you want to hold a flexi cap alongside, keep it as a minority of the category. Explicitly not in this category are mid cap, small cap, sectoral funds, thematic funds, and direct stocks. Those are want bucket and aspiration bucket instruments. People ask whether a balanced advantage or aggressive hybrid fund can do. You have handed the equity debt decision to a fund manager who runs a model portfolio and has no idea what year your goal is. You get simplicity, you lose the glide path. For a need goal, that's an expensive trade. Let's take an example. Let's say you're targeting 40 years in 9. Let's take an example. Let's say you need 40 lakhs in 9 years from now. You already have 8 lakhs set aside. Step 1 is 9 years. So the horizon band allows you 45% equity, and a 40% fall in the equity portion in year 8 would leave you short by roughly 6 lakhs. Recoverable with a 1 year delay and a top up. You pass, you are in grid 2. I don't get it. What? And a 40% fall in equity portfolio in year 8 would leave you short by roughly 6 lakhs, recoverable within a 1 year delay and a top up. You pass the test, you are in grid 2. मुझे नहीं समझ आया उनको क्या आएगा. So 45% of let's take an example. Let's say you need 40 lakh rupees 9 years from now, and you already have set aside 8 lakhs. So first of all, 9 years is a long horizon. You can have a band of 40 to 45%. Even a 40% fall in the equity portion in year 8 would leave you a shortfall of 6.5 lakhs, which is recoverable with a 1 year delay. So these two criteria will fulfill that you are in grid 2. Now 60-40 split of the existing 8 lakhs, 4 lakhs 80,000 in debt, 3 lakh 20 in equity. Step 3 would be the size of monthly contribution. At the blend assumption of around 9%, which is a combination of debt and equity, you can lower down if you want more secure allocation. The existing corpus grows to roughly 17.5 lakhs. The gap still continues to be 22.5 lakhs, which needs a monthly contribution of 13,500 rupees. So step 4 is also split the SIP in the same allocation, 8,000 into debt and 5,500 into equity. Same 60-40 split. Obviously, you can make changes to these assumptions and accordingly recreate this plan, but you broadly understand how the structure should be. The 40% is not a permanent setting. It's a starting position that must decay. Years 9 to 5 hold 40% equity, rebalance once a year on a fixed date, not when you feel like it, on a date in your calendar. Year 5, step down to 30%, year 3 to 15, year 2 to 0. From here, it becomes pure debt category allocation. And this is critical. These steps are triggered by the calendar, not by market. You do not wait for a better level to sell. You do not postpone because equity has been running well. The whole point is that you're removing your judgment from a decision where your judgment is not needed and is quite likely to be wrong. One practical note, equity gains held over 1 year are taxed at 12.5%. Debt units that are purchased after April 23 are taxed at your slab rate, whatever is your holding period. So when you're stepping the equity down, doing it across 2 years can use 2 years worth of that exemption. These are tax laws. They can change with time depending upon when you're watching this. You should refer to the latest tax notification. Here are some of the mistakes. Using the moderate label to justify mid-caps. I see this constantly. Somebody reads moderate means you can hold equity and interpret it as moderate risk equity, which they take to mean mid-caps. No, moderate refers to the proportion of equity, not the type. The type stays broad and large. Mistake 2, never actually running the glide path. People set up 60-40 beautifully and then they leave it untouched for 9 years. By year 8, after a good run, equity is 55% of the bucket and they have an aggressive portfolio wearing a moderate label at exactly the moment they can least afford it to be. So they need to reduce it, which people often forget. Mistake number 3, mixing this bucket with everything else. If you need money, want money, aspiration money, sit in one demat account, one folio, it is very hard to segregate. So it is better to have separate portfolios, separate folios, and there should be a goal tagging for the same. Most platforms support this now. 1, your temperament cannot buy you more risk in the need bucket. Only the horizon can. Only if the goal survives a 40% equity fall. 2, if you pass both tests, roughly 60% debt, 40% equity. 3, the allocation decays on a calendar, not on market view. In the next video, we finish the need row. We'll combine the need and aggressive portfolio, which is, in my experience, the cell where most well-intentioned financial damage in India actually happens. I'll show you with specific version of what I see. See you in the next one. Thank you for watching.